Alright folks, so long time no see. We are back with a new refined basic video, master the basics. We will immediately hop over all the topics which are simply market structure, very easy, CISD or break of structure, OTE, the fair value gap, the entries or two entry possibilities, better mentioned as risk to reward, risk management, and also the higher time frame. The most important is to master all of these in combination. It's like riding a bike or learn how to ride a car by learning and understanding what the brake does, what the clutch does, and what the gas pedal does. If you ride an automatic car, then you just need the gas pedal and your brake. But you still need to figure out what all the components in the car do. Because if you don't know how to handle a steering wheel or you don't know how to handle your brake exactly and accordingly, you wouldn't even get far. And that's the problem with a lot of people in trading. They don't understand how to combine the basics. It's very, very simple, and these topics you may already have 100% heard of and you may already understand them. But combining them is like riding a car and learning how to ride a car, or learning how to ride a bike. You don't learn how to ride a bike by simply sitting on it, understanding what the brake and the clutch is, and maybe the biking pedals, and then you go. It doesn't work like that. You need to figure out the balance. You need to figure out your mindset. If you're stable on the bike, if you've never ridden a bike before, or the difference between electric bikes or sport bikes or even downhill bikes. The tires are smaller, also in cars, if they are wider, if they are longer. If you drive a fucking Mercedes S-Class, then, well, most of you will crash it after a few weeks because it's so long. And that's the problem. Understanding the basics in trading is like riding a car and learning how to ride a car. It's very simple if you have it down. If you see it, you can't unsee it. If you can do it, you cannot undo it. And that's the main goal. We are straight gonna hop into the market structure aspect. As you see here, you simply have, as mentioned already in previous videos, higher highs, higher lows, or in this case, lower lows and lower highs. Market structure doesn't work like that. Yes, it may look quite nice sometimes if it just forms higher lows, lower lows, higher lows, lower lows, or whatever. But then there's this example where market will induce above old highs or old lows to grab liquidity to absolutely make no sense, and then move in the opposing direction, in your market structure direction. True market structure will always move to your next low or high, which you want to target. Okay, if you're bearish, you will target the previous low. The thing is, what happens in between in the lower time frame, you don't care, it doesn't matter. It's like riding the car. Again, I will come back to the car example a lot of times in this video. Riding your car, you press the brake or you press the gas pedal. This is pressing the gas pedal. Market structure is going into the charts, opening trading view and pressing the gas pedal on your car. What happens in your car and the whole system behind it, the clutches and everything, you don't care about it. It just simply happens. And that's the lower time frame of the chart. It doesn't matter what the 1 minute or 2 second time frame looks like. If your higher time frame is bearish and you're targeting a lower time frame, or even in this case, higher time frame lows or highs, depending on your bias, then you stick to this. It doesn't matter if you induce lows or highs in the 1 minute time frame, and that's why I also always mention that the 1 minute break of structure is complete waste of time. Because learning the 1 minute break of structure, it's too confusing. It's like trying to explain a person who have never driven a car how a clutch works. They don't even know where the gas pedal is. Why do they need to understand how a clutch works? Keep in the back of your head that the lower time frame swing highs and swing lows can be induced, as already seen in this picture. The CISD. For the CISD, it's very simple and straightforward. We wait for the swing low, or in this case, the swing high, which broke a swing low or a swing high, to get candle closed. In this picture, you can see two pictures which are exactly the same. One with the lining and one which is simply a chart example, where you then come into a key area which in this case I think was an order block. And then after that, market pushes higher immediately. It skyrockets and breaks over the swing high with just green, or in this case white candles. This is called a CISD. We will get back to this example later. A CISD, or also called break of structure, occurs mostly when you are in a key level and market is about to shift. Just imagine that the lowest swing low in here is hitting a demand zone or a key area, a fair value gap, internal liquidity. If you haven't ever heard of that, I would definitely recommend you to watch my 5 episodes where I simply break everything down from A to Z, which is absolutely helpful. Swing lows and swing highs are the main focus in this point. That's where all your focus should go to. The OTE. An OTE, or also called the optimal trade entry, is not necessary. But a lot of people use the Fibonacci tool. In this case, you can clearly see market is bullish and you have a swing high and a swing low here. The swing low broke above the previous swing high. If you look at the 0 level from the Fibonacci, that's where your new swing high comes into the market. After this CISD in the higher time frame or simple market structure, you can draw a Fibonacci tool around the swing low from the swing high, because you don't know where market will pull towards to. It's also called a golden area, a key area, whatever you want to call it. But if you use 2 brain cells more, you can already figure out that you want to buy below the 50% level, which is also called the equilibrium. The OTE, also called the golden area, is always below the 50% level. You don't have to even draw in the 62 or 70% level. It doesn't make sense. If you're bullish, you simply want to buy below the 50% level for the best prices. It's like me telling you to buy Bitcoin right now, or you could have bought Bitcoin at 10K. Well, everybody would have wanted to buy Bitcoin at 10K, missed out on that, in this case by now. But well, if you are bearish though, you want to sell above the 50% level. Selling a Bitcoin right now would be tremendously dumb. Selling a Bitcoin at its peak at 110K would be quite nice. But the overall understanding of an OTE, or entering based on OTEs, you don't have to use a Fibonacci tool. You can also just simply use your main focus, your eyes, and maybe look for key areas below or above the 50% level. If you haven't understand this yet, watch episode 1 to 5 again. A fair value gap is simply a gap between 3 candles where market induced and moved higher in a certain direction without mitigating anything. There is just a lot of orders, and for these amounts of orders to accumulate in market and to distribute them to one side, you need at least 10 banks to do that, because there's so much volatility, there's so much cash flowing, and there's also so much cash which is getting missed out on. And that's why 90% of the times fair value gaps will get mitigated. If you haven't heard about it, it's also a nice calling called internal to external structure. I think T-Trades made a very cool and nice video about internal to external structure, which could be a homework video for you to simply understand better where to target or what to target if you have a fair value gap, or if you're just taking out a swing high. Fair value gaps come in different variations, also explained in my 5 episodes about volume gaps, simple market gaps, or the fair value gap. For further understanding, you can check out other videos which I uploaded. The fair value gap is a gap where market had a lot of volatility and left a big gap to remitigate. Wicking below a fair value gap does not mean it is invalid. So if you come right now into this fair value gap, but market wicks below it, it doesn't mean it's invalid, only if the candle where the fair value gap got filled. So in this case, if this is a 4-hour time frame here, and these 3 candles are 4-hour candles, and then another 4-hour candle mitigates this fair value gap, but it only comes into this fair value gap and then spikes higher. That's a mitigation. If you close below the fair value gap with a 4-hour candle, okay, you're still in the 4-hour time frame right now, then it's invalid. Then you can use the fair value gap again to maybe catch some sells. The entry #1. Or the simplest entry, you always wait to come into a key area. It doesn't matter if it's the order block, a demand area, a swing high, a swing low, previous day's highs, previous day's lows, session highs, or simply a fair value gap as already learned. If you are right now at this point in a fair value gap, which means you are in a key area, you can then go into a lower time frame, which is market profiles, and then wait for a CISD, so a swing low or a swing high, which broke the swing high or which broke the swing low. In this case, the swing high, which breaks the swing low, getting candle closed bullish wise, and market is in a key area, which could mean, well, you just mitigated internal liquidity or this fair value gap, and we want to expand higher. There's two nice examples to catch a nice and simple market structure based entry with your already knowing knowledge about order blocks and fair value gaps. You wait for the CISD, you have the fair value gap entry where you wait always for a CISD, and then maybe market gives you a nice fair value gap, such as in this first example here. All the way on the right on the two pictures, you can see the order block entry. You still wait for the CISD, but in this case, market mitigates the order block. So you can mark out the order block, which is the last black candle after the CISD occurred. So you have this black candle, and for those who are smart, you also have a fair value gap in between here. These are exactly the same pictures, just a little bit bigger on the order block one. The order block got remitigated, so you could have entered on the fair value gap or on the order block, it doesn't matter. Entry possibility number 2. The intermediate entry is directly after the CISD. Sometimes market is too volatile to wait for a pullback into a higher or also lower time frame key area. This picture or picture number 2 is in the 1 hour time frame. The first picture is in the 15-minute time frame. So as you see, in the 15 or 5-minute time frame, if you break it down into the lower time frame, we mitigate a key area. And this is also the first example where we talked about the CISD. You come into a key area, you then form a clean CISD with a tremendously big push where we skyrocketed higher, and entering immediately after the CISD occurs would have meant you would have been into this trade. If you would have waited for a pullback into the order block or into a fair value gap, you will most likely have missed out on this trade. Because the pullback was only the two tiny black candles in the first picture here, where, well, there wasn't anything to remitigate. And the order block would have been the tremendously big push downwards before the big push upwards, which is also called a range, or in this case, your bigger order block. And if we then also look into the higher time frame, market skyrocketed absolutely higher. So there was no re-entry possibility, but you would have missed out on a very clean trade. This is my personal favorite entry technique, entering after the CISD. The risk to reward is a little bit bigger though, but still you would have missed out on this trade if you waited for an order block or fair value gap entry. So we will come back right into the risk to reward and risk management. Risk management is the most important thing about trading, because I will show you two pictures where you can simply understand if your risk management is on point. Then it doesn't matter if you trade coin flips, if you trade retail, if you trade ICT, it doesn't matter if you trade patterns, or if you simply trade CRT or other strategies. Everything comes down and back to your risk to reward and your risk management. Leverage is something which we will not speak about, because leverage is varying between the brokers. Leverage is something where if you pay in $10 on your funded account or your live account, and your leverage is 1 to 100, then you have $10. If your leverage is 1 to 500, then your $10 turn into $50, even though you only have $10 in your account. So this is not proper risk management. I will always 100% always recommend you to trade a 1 to 100 leverage, or if your broker or prop firm only allows a 1 to 30 leverage, that's even better. You can still risk 1%, it doesn't make any difference, but it just means if you have a 1 to 30 leverage that you cannot risk 3% on a trade, because otherwise I think your account would be breached within no time. Here you see a picture of me journaling 2023, a complete year. Backtest the whole year and you will get all the data that you need. It doesn't matter which strategy, whatever strategy you use, sooner or later you will come to the point where you have to do this. You need to calculate and figure out what your average risk reward is, your win rate, your maximum consecutive losses, which simply mean how many losses back to back can you take before you completely breach your account. In this case, my maximum consecutive losses in year 2023 with CRT was 6 losses. So I had 6 losses back to back, and then after that I made a profit. And also your main profits. In here you can see all the risk rewards come down to a total of 113.67% if you would have taken absolutely no partials. And if you've taken partials, if we divide this number by 2, your average and total profit after this whole year would have been around 56%. And if you round it up, it's around 60% because your account also multiplies and gets more money if you make more profits. And if you trade on your 100K account, you would have made $60,000 within a whole year. And if you would have taken no partials, you would have made $113,000 and $670 on a whole year trading this strategy. My win rate is around 82%. And what is a win rate and why do we need it? Well, let me explain it, because a lot of people have already seen this picture, but they don't understand what it means. Your average risk reward is what your win and loss risk reward looks like. So if you have a 1 to 2, which means you can make double the amount that you're risking, or you have a 1 to 3, which means you can make triple the amount that you're risking, and my average risk reward lies around a 1 to 3. Sometimes I get a 1 to 6 or a 1 to 7, and rarely I get even above 1 to 10s, but I will not calculate this in because it doesn't involve into my trading plan, where I simply trade my 1 to 2, 1 to 3, or 1 to 5s. Let's simply focus on the 1 to 3. You only need a 30% win rate, which is tremendously bad, to be profitable. In this case, if you have a 1-to-1 risk reward, you at least need a 60% win rate, which means out of 10 trades, you need to win 6 to be profitable. Otherwise, you would lose. If your risk reward is 1 to 2, you only need a 30% win rate. If you have 10 trades and you win 3 out of the 10, which means you would have made 6%, you're still up 1%. And if your average risk reward is 1 to 5, congratulations, your win rate only acquires to be 20%, which not even the baddest trader on planet Earth will have. So you only need to win 2 trades to be profitable out of 10 trades. My average risk reward is 82%, which means I only need to win 1 trade, 1 simple trade with my average risk to reward, and then I am up in profit. And that's something which you need to journal for your own. I don't know where to trade. I don't know what you enter on. If you use entry 1, if you use entry 2, if you enter after the CISD, we will have quite the same risk reward and average outcome and profits. If you enter only on the wick or even lower, well then maybe you have a 90% win rate, or your win rate is lower, which is just simply 60 or 70%, but your risk reward could potentially be an average around 1 to 8, which is quite good. If your risk reward is a 1 to 8, you also only need to win 1 single trade out of 10, and then you will be set for life. And this is the hard part, getting over this psychology and trying to understand that it's okay to lose some trades, and it's also okay to not win every single day. But if you have this down, It's simple and you will totally understand and be profitable within a whole year. Thank you. I hope you enjoyed. And for the higher time frame, we will have a separate video where I will go over step by step how I mark out the higher time frames, how I take entries, how I place my trade, where my risk reward goes to, how I journal, and everything in combination. I hope you enjoyed this video, which is simply about mastering the basics. If you have any questions, leave them down in the comment section below. Press subscribe and don't forget to like. And if you want, you can join my free Discord. And I will hopefully see you in there.